Welcome to this explainer, everyone. Today, we're unpacking a truly fascinating dynamic. We are looking back at March 2026, a month that's absolutely going down in the financial history books. We're going to analyze how everyday investors, just acting with quiet discipline, completely turned the tide of a massive global macroeconomic storm. It's a stunning story of resilience, and the data maps out exactly how it all happened. So let's dive right in.
Right off the bat, I want to hit you with this number, 2.94 lakh crore rupees. Let the sheer scale of that figure just sink in for a second. This was the massive net outflow from debt mutual funds in a single month, March 2026. Capital was literally fleeing the debt markets at breakneck speed. This number is our baseline today, because it establishes the incredibly severe stakes and the sheer panic sweeping through certain segments of the financial world right at that moment.
Which brings us to the core question of today's explainer. How exactly does a global macroeconomic crisis, one that triggers almost 3 lakh crore in debt sell-offs, somehow coincide with a record-breaking historic month for everyday individual investors? It's honestly a modern-day David versus Goliath story. On one side, you've got the Goliath of global panic, oil shocks, and institutional sell-offs. On the other, David, the retail investor. But before we get to David, let's break down exactly what Goliath looked like.
Part 1. The Global Market Storm.
Before we can fully appreciate the shield, we really need to understand the storm. Late February and March 2026 were defined by severe hits to global macroeconomic stability. The markets weren't just reacting to domestic policy. They were dealing with massive global tectonic shifts. This cascading crisis kicked off in late February with the escalation of the US-Israel-Iran conflict. As those tensions rose, Iran intensified its control over the Strait of Hormuz. Now, why does that matter to us? Well, that strait is a critical transit point for over 20% of the world's global oil supply. That disruption sent an absolute shockwave through energy markets. By mid-March, this translated into massive supply-side pressure on bonds, pushing Indian 10-year benchmark yields up to a 16-month high of 7.02%. And by the end of March, the broader equity indices were reeling. The Sensex plunged 11.5%, completely slipping below the 74,000 mark.
Chapter 2. Debt funds feel the pinch. So, equity markets are sliding, but let's shift our focus to the immediate casualty of these macro shocks, the debt funds. This is where that massive 2.94 lakh crore outflow we saw earlier really comes into play. What's super interesting here is how it separates emotion from economics. You see, the debt sell-off wasn't just blind panic. It was a mathematical reaction to some very specific factors. The conflict pushed oil prices way above $100 a barrel. For India, which remembers the world's third largest oil importer, that instantly triggered major fears about rising import costs and domestic inflation. Toss in the Indian rupee hitting fresh all-time lows, and you've got a problem. Finally, compounding all this global stress was a domestic, seasonal factor. Massive corporate redemptions to fulfill advanced tax liabilities at the end of the financial year. Talk about a perfect storm.
The result of that perfect storm? The AUM for open-ended debt funds shrank by a staggering 15% in a single month. They dropped from over 19.4 lakh crore down to 16.5 lakh crore. I mean, a 15% contraction in just 30 days? That highlights exactly how violently capital was moving out of these debt instruments amid all those inflation and yield fears.
Section 3. The Retail Investor's Shield. Now, here is where our explainer takes a huge pivot. We've seen the macro storm, the plunging Sensex, the soaring oil prices, the fleeing debt capital, right? Now let's look at the micro shield. Let's see how domestic institutional investors and, most importantly, everyday retail individuals reacted to this exact same news cycle. While foreign capital was panicking over geopolitical risks and debt markets were seeing massive sell-offs, domestic institutional investors did the exact opposite. They didn't just hold the line, they quadrupled their purchases. DIIs actually acquired equities worth a staggering 1.42 lakh crore rupees in March alone. They looked at an 11.5% plunge in the Sensex not as a reason to panic, but as a massive buying opportunity.
Despite the conflict, despite the oil shocks, equity mutual funds logged positive net inflows for the 61st consecutive month. Let me repeat that for a second. 61 straight months of positive inflows. That is 5 solid years of individuals continuously pouring money into the market, completely bucking the global downward trend that was shaking the debt markets to their core.
Moving to the next section, rapid fire, the power of SIPs.
To really grasp how this financial fortress was built, we have to look at the household level. We're going to do a rapid-fire drill down into the specific data behind systematic investment plans, or SIPs, because this is the absolute bedrock of that 61-month streak. First up, 10.47 crore. That's the number of active SIP accounts in India as of this data. They actually added 2 lakh new accounts in that turbulent month alone. This isn't just a handful of billionaires moving the markets. This is over 100 million active, automated accounts quietly absorbing the shockwaves of global conflicts.
Bring that down to the absolute micro level and you get this number, 2,957 rupees. That was the average monthly SIP ticket size. And what's really fascinating here is the psychology behind it. When you're systematically investing under 3,000 rupees a month, you aren't out there trying to time the geopolitical cycle of the Strait of Hormuz. You're just consistently buying. This small, seemingly boring number is actually the ultimate financial fortress.
And when you multiply that everyday discipline across those millions of accounts, you get our punchline, 32,087 crore rupees. This was the record-breaking all-time high for monthly SIP contributions, and happened right in the absolute middle of a global market panic. While the headlines were screaming about oil and yields, retail investors systematically injected over 32,000 crores into the market. No panic, just execution.
Chapter 4. Where the Money Went.
So, we know the money came flooding in from retail investors and DIIs, totally defying the broader market sentiment. But where exactly were they deploying this massive wave of capital? Well, flexi-cap funds led the pack for the 8th consecutive month, capturing a massive 10,054 crore rupees in net inflows. Investors clearly favored the flexibility of fund managers to navigate the volatility across market caps. But they didn't shy away from risk either. Small-cap and mid-cap funds followed closely, bringing in over 6,200 and 6,000 crores respectively. Combined, these 3 categories absorbed more than half of all equity inflows for the entire month.
Pulling back to look at the entire mutual fund industry landscape, we see a remarkably healthy picture. Even with that 15% contraction in debt funds we talked about earlier, the total industry AUM stood robustly at 73.73 lakh crore rupees, and it's heavily supported by this equity dominance, making up 55.1% of the pie. The retail shield essentially backstopped the entire industry's asset base.
Which brings us to our final section, the big picture takeaway. These numbers from March 2026 aren't just dry statistics, they're an incredible behavioral case study. The Association of Mutual Funds in India put it perfectly in their official report. To quote them directly, it reflects sustained investor confidence in long-term wealth creation, highlighting the growing preference for disciplined, systematic investing. This honestly validates everything we've looked at today. The market didn't survive the March 2026 storm because the storm was weak. It survived because the behavioral discipline of the retail investor was just incredibly strong.
I want to leave you with this final provocative thought. We just saw how a seemingly insignificant average monthly habit of 2,957 rupees, when applied systematically, literally acted as a shield for an entire domestic market against a fierce global geopolitical and macroeconomic storm. So ask yourself, if that level of boring, automated discipline can hold up the broad market, what could that exact same habit do for your own personal, long-term wealth? That is the real lesson from March 2026. Thank you so much for joining me for this explainer. Keep learning, keep investing systematically, and I'll catch you next time.